If you think the global economy runs only on factories, oil tankers, and massive container ships, then you need to wait until you see what happens when a single country quietly decides to change the rules of money. Because what is happening in Japan right now is not loud, and it's certainly not dramatic, but it is powerful enough to make global markets everywhere hold their breath. And once you understand this quiet earthquake, you will never look at global finance the same way again. For decades, Japan has been the silent engine behind global risk-taking. It has been a place where money was so incredibly cheap it felt almost free, and investors around the world built entire financial strategies on the massive, unspoken assumption that this would simply never change. But right now, that assumption is cracking, and the shockwaves are already moving through currencies, stocks, bonds, commodities, and even precious metals in ways most people don't yet fully grasp. To truly see why some headlines are now saying that Japan has effectively started to shut off the global economy, we need to rewind and understand exactly how Japan became the financial heartbeat of the modern world without most people ever noticing. Imagine Japan's economy as a giant quiet pump that circulated liquidity across the planet. Due to years of fighting deflation and keeping interest rates near zero, the Japanese yen became the ultimate funding currency. This is known as the yen carry trade. Here's how it works. Investors would borrow yen at practically 0% interest in Tokyo, immediately convert that yen into dollars or euros, and then use that massive pile of money to buy assets anywhere else in the world, in higher-yielding U.S. Treasury bonds, volatile emerging market stocks, or even high-risk corporate junk debt. The returns generated from those assets were far higher than the 0% they had to pay back on the loan. It was a massive, guaranteed profit machine, powering global investment booms from Sao Paulo to Sydney. This flow of Japanese cash was so huge it distorted global markets, essentially subsidizing risk for everyone. Want cheap money to buy your first home? Thank Japan. Is your favorite tech stock skyrocketing? Japan's cheap money was probably helping push it higher. This system was incredibly stable, as long as Japanese interest rates stayed stuck at zero. But here's the game changer. Japan has finally started raising rates. For the first time in 17 years, the Bank of Japan moved away from its negative interest rate policy. It was a small move, but its implications are absolutely staggering. That small rate hike starts to dismantle the core mechanism of the yen carry trade. If borrowing yen now costs more, those international investors start unwinding those huge positions. They must sell the global assets they bought, stocks, bonds, property, to pay back the now slightly more expensive yen loans. This act of unwinding sucks liquidity out of global markets like a vacuum cleaner. It means less demand for U.S. treasuries, putting upward pressure on American interest rates, making your mortgage more expensive. It means forced selling in other markets, which creates volatility and sharp drops. Japan is not collapsing. It's simply normalizing its rates, and in doing so, it's proving just how much the global financial system relied on its free money drug. This quiet shift is going to be the central story of the next few years. Make sure you hit that subscribe button so you don't miss our deep dive into the specific assets most at risk. Thanks for watching. After Japan's massive asset bubble burst in the early 1990s, the country was plunged into what became famously known as the lost decades. This wasn't just a slight hiccup. It was a long, painful era defined by low growth, persistent deflation, and deep economic stagnation. The Japanese economy simply stalled out. To fight this relentless slump, the Bank of Japan, or BOJ, had to get radical. They started slashing interest rates, pushing them lower and lower until they eventually hit zero, but even that wasn't enough. They went even further, venturing into negative territory, a move that seemed unthinkable at the time. For years, Japan maintained some of the lowest borrowing costs on Earth. Think about that for a second. Imagine a bank that practically pays you to take money out. That's essentially how cheap yen funding became. This monetary policy created a unique and powerful global financial phenomenon known as the yen carry trade. The mechanism was brilliant in its simplicity and staggering in its scale. Investors realized they could borrow enormous amounts of yen at these ultra-low rates, sometimes near zero, and then immediately take that money and invest it in assets anywhere else in the world that offered a higher return. They were essentially arbitraging the interest rate difference across the globe. The yen became the absolute fuel that powered global speculation. Trillions of dollars flowed through the system. Where did it go? Everywhere. Investors poured yen into higher-yielding U.S. stocks, into emerging market bonds, into real estate portfolios across Europe and Asia, into commodities like oil and gold, and eventually, even into the volatile new world of cryptocurrency. The key was to borrow cheap in Japan, invest anywhere else, and then just pocket the significant difference in returns. When markets were calm and predictable, this system worked beautifully. It quietly linked Japan's domestic monetary policy directly to the price of assets worldwide. That is why when you hear analysts talk about the yen, they aren't just talking about Japan. They are talking about the potential stability or instability of nearly every major market sector globally. It's a delicate structure, though. This cheap flow of capital created huge demand for assets, pushing prices up globally. But what happens when the Bank of Japan finally decides to raise rates, pulling the cheap fuel away? That's the question that keeps global investors up at night, because when that fuel source disappears, the carry trade unwinds, and the resulting market shockwave could be felt everywhere from Wall Street to Shanghai. Stick around as we dive deeper into what a BOJ policy shift could mean for your investments. Don't forget to subscribe so you don't miss the next video. Thanks for watching. But cheap money, as we all know, always comes with a hidden cost. And over time, Japan's unique monetary policies didn't just affect Tokyo. They fundamentally distorted global financial markets in profound ways. Think about it. When money is essentially free, the natural incentives of investing break down. Investors eventually stopped asking the critical question, is this asset truly valuable? Does it generate real returns? Instead, the question became much simpler. Is the money cheap enough to justify buying this asset, regardless of its underlying value? This subtle shift in mindset moved the focus from fundamental analysis to pure liquidity chasing. As long as Japan kept its short-term interest rates anchored near zero, and as long as they aggressively suppressed bond yields through massive, persistent bond buying, the system kept running smoothly, or at least it appeared to. The Bank of Japan eventually took this unprecedented strategy a step further by implementing what they called yield curve control, or YCC. This was a radical intervention. It was essentially a public promise to the entire world that the Bank of Japan would cap long-term interest rates at a certain level. If yields threatened to rise above that cap, the BOJ committed to buying an unlimited amount of government bonds until those rates were forced back down. Unlimited buying. Let that sink in. This wasn't just another economic tool, it was a powerful signal. It told the world, loudly and clearly, that Japan was willing to do absolutely whatever it took, deploying infinite monetary resources if necessary to keep money easy and the cost of debt low. For 2 decades, global markets absorbed this promise. It became ingrained in their DNA, shaping investment strategies everywhere. Everyone knew that if money was globally tightening, there was still one major central bank committed to easy money, meaning that vast pools of cheap capital would remain available to fuel global investment trends, carry trades, and risk-taking. This created a major structural dependency. When the source of the cheapest money on the planet is committed to staying cheap, it inevitably creates bubbles and misallocations of capital in the search for yield. Funds poured into global assets, from real estate to emerging markets, all financed by the lowest possible borrowing costs out of Tokyo. But what happens when that core promise begins to wobble? What happens when the Bank of Japan finds itself backed into a corner, unable to sustain the policy that the entire world has built its cheap money house upon? That's when the real distortions begin to unravel, creating immense pressure on global interest rates and currency markets. We're talking about the potential end of the carry trade era and a huge adjustment for anyone who has relied on this cheap liquidity. If you want to understand the current squeeze in global finance, you have to look here first. Thanks for watching, and don't forget to subscribe for more deep dives into the global economy.